Welcome to Lesson 3 of the Legal and Financial Essentials course of the Nonprofit Bootcamp e-learning series. Digging into the various legal, accounting, and financial aspects of your business is critical to success, yet it can also be intimidating, especially for smaller nonprofit organizations. This course will cover the basics of legal and accounting as well as more specialized accounting issues in an understandable way, helping you to action out your legal to-dos with confidence. We will cover fiduciary responsibility, accounting requirements, and issues that are specific to nonprofits working with food. Today's lesson, Special Accounting Issues, will explore the accounting nuances that are specific to nonprofits dealing with food. Today's presenter is Poppy Davis. Poppy teaches and advises on business and policy issues affecting family-scale farms and ranches and related associations. She is the Director of Entrepreneurship at the Indigenous Food and Agriculture Initiative at the University of Arkansas School of Law and consults for farm programs across the country. Previously, she was the National Program Leader for Small Farms and Beginning Farmers and Ranchers at the USDA, and prior to that, a California CPA. She holds a Juris Doctor from Drake University Law School, a Master's in Journalism from Georgetown, and a BS in Agricultural Economics from the University of California, Davis. Poppy, take it away.
Thanks, Annalena. Good morning, everyone. Thanks for joining us again for the final part of this series. So I think probably most of the people on the phone were at the first two sessions we did with me. The first one was on nonprofit ethics and board accountability and what senior managers are responsible for. And then the second one was a big overview of all the things your accounting system has to do. This one is a drill down into some special advanced issues. Mostly are going to have to do with tax and tricky areas of law. Before we get into these advanced issues, I want to set some really clear learning goals, because I know that after the last two webinars, several people said that it was really a lot of information and maybe too much information to take in. This is even more information, but the good news about this information is that I really think for most of you, certainly for most of you this year right now, these are just topics that you should be familiar with. And there isn't a lot you're going to need to do about these topics. But my main goal for you is that if you're ever in conversation with anybody and you start talking shop about nonprofits and any of these topics come up, it won't be the first time you've heard these topics. You will have some familiarity with them. A couple of things here that you'll probably want to go check on, but this stuff isn't as complicated as you might think, even though it is very complicated in an advanced sense of really digging into the legal details. It's not particularly complicated for most small nonprofits. You just have to have some awareness and some common sense, and when it does affect you, have the processes in place to take some action. So we'll start out with a review of the sources of nonprofit law to get you oriented to what it is that makes a nonprofit and what governs nonprofits. Because it matters to understand the different sources of law that are applicable to you. We're going to talk about special accounting requirements for federal awards, far and away the most technical subject. People devote their entire professional lives to these accounting requirements. I'm just going to give you the orientation that they're out there and when they apply to you. And then everything else we'll talk about is basically reference what we talked about last week. You're going to need a good accounting system. You're going to need a good accountant to help you. The 1023 and the 990 are documents you file with the IRS. We'll talk about them. We'll talk about why they're public and why that matters and how to be consistent in all of your communications with the public and through the 1023 and the 990. We'll touch quickly on unrelated business income tax, which some of you may have some questions on if you are farming through your nonprofit and selling some of that farm product. That'll probably be something we'll go over into Zoom and talk about some more. We'll talk briefly about private inurement, which just means any private benefit to a private individual, how to spot it, what to do if you spot it. And then we'll look at the end at a quick case study that's current from the Coalition of Immokalee Farm Workers. So to get us oriented to the law of nonprofits, where nonprofits fit in all of this. So first of all, your nonprofit is going to be incorporated under state law. Unless you're in the District of Columbia or possibly on an Indian reservation, then it would be incorporated slightly differently. But most of the nonprofits will be incorporated under state law. Your nonprofit is going to be tax exempt under federal law. That's true for everybody. You may also have a separate tax exempt status under your state, but that's a state law issue. But most of the time, really most of the time, when we talk about a nonprofit organization, that's shorthand for tax exempt under federal law. And we'll talk about that quite a bit more in this whole webinar, what that really means. So as part of being incorporated under state law, you can sue and be sued the same as with any other kind of individual or business entity. The key thing is that the federal tax exemption stands in all sorts of other situations. It allows the organization to receive donations that the donor can deduct from their income taxes. And so that puts the organization in a special status. And it also allows the organization to compete for and receive state and federal grants and cooperative agreements that wouldn't be available to other kinds of organizations. The tax exempt part isn't what really matters there. It's the ability to apply to compete to get these funds. And so that's the IRS federal tax status stands in and gives these other privileges to the nonprofit. Important to understand that when you receive a state or a federal grant or award, cooperative agreement award, that's a contract. And the language of the grant or award is contract language. And the organization has to comply with the accounting requirements that are going to be buried inside of that grant or co-op agreement. We'll talk about that some more so you have more awareness about what those kinds of accounting requirements inside that contract are. And then in addition, very often, state and federal government will impose additional regulatory and compliance requirements on the nonprofit, basically just because it can. Because we're giving you money, we're going to hold you to a higher standard. It's in the contract. So you may have to look at those things in understanding your contract. So the 1023 is the application you file with the IRS to receive exempt status. The exempt status gives you certain rights and privileges, and you may need to file a separate exemption with the state. We're going to talk about what goes in the 1023 a little bit more later. When you file the 1023, you're filing for exempt status within the Internal Revenue Service code, and that code goes through the alphabet, but the subchapter F of the Internal Revenue Service code covers exempt organizations. And if you can see from this quick index here, part 1 is the general rules, and we're looking for 501c3s, right, which you've heard of. So you can see from just skimming this that subpart F is pretty big in and of itself, and there's a whole bunch of other stuff underneath subpart F. So within the 501 part, the general part, C3 is most charitable nonprofits. C4 is most membership associations. C4 is going to do a lot of the heavy lifting on federal policy issues, could be state or local policy issues too. But C4 is typically distinguished from a C3, usually by its political activity. There's other kinds of typical 501c something organizations that you may see around. But the key thing about Section 501 is that it allows this exemption from taxation if you can find your place under this code where you fit. It accounts for tax on unrelated business income. That's 501B, right before you get to C. We're going to talk about unrelated business income towards the end of this webinar. The C is certain kinds of exempt organizations that are allowed to be exempt from tax. And there's the 3, and this is where most of us are. It's organized and operated exclusively for religious, charitable, etc. That's where you're going to fall. And most actually are going to fall under educational. Most of the organizations on this phone, probably not religious, may have a charitable component in the sense of directly alleviating hunger and poverty, but most are going to fall primarily under education, so it would be food access and nutrition access, more in a sense of education than in a sense of immediately alleviating immediate hunger. Point 501c goes all the way up to 29, so C3 is just one of the long list, and then 501d is where the religious organizations start. So that's the orientation. So if you're there, if you're under 501c3, then you get to compete for state and federal awards, and you may win them. And part of why Wallace is doing this webinar series is that so many nonprofits that work in food and agriculture compete for USDA funding, because the USDA has lots and lots of great funding sources that are really relevant to the kind of food work and farming work that we do and that we're interested in. But all those funds come with really difficult accounting requirements. So there's uniform law across all the federal agencies on how nonprofits that receive these federal monies can account for them, or how they must account for them. The general rule is that you're reimbursed for your direct costs directly associated with the program that you're doing, and you can have an allocable share of your indirect costs. For small organizations, that's up to 10%, or you can negotiate your indirect rate, which any large organization has done. And for reference, universities have indirect rates that run around 30%, but some universities have indirect rates that run up to as much as 60%. So the 10% is the very small organization default. And my main advice to you in this section is to not spend too much time in the 10% zone, because you'll go broke if you're not having all your overhead reimbursed. And that is part of why I became interested in working with small nonprofits, was seeing nonprofits get in real trouble with what looked like a great federal award and not doing the math to realize that they were subsidizing the government because the federal award didn't adequately cover their true overhead. So understanding where these accounting requirements come from, federal law governing how the feds spend money. There's contracts, which is generally not going to be you. And then there's grants and cooperative agreements, and you may be involved in either. If you're working through the USDA, it's usually going to be a cooperative agreement. The key distinction between grants and cooperative agreements is the degree of substantial involvement. Probably most of us think substantial involvement sounds like the kind of person that you talk to on a pretty regular basis, and a lot of people have probably had co-op agreements with the USDA where they didn't really think that it was really substantial involvement. But that's the phrase, that's what they're looking for, that's their terminology of what they're held to. And it does mean probably most of you who've had these kind of agreements, you will have some back and forth with the local office so that you can both demonstrate that you were in touch during the course of the agreement to make sure that the agreement was aligned with the needs as originally defined by the whole award process. So the key thing that is required for a cost to be allowable, and when I say allowable, it means you can put it on your bill and you can send it to the feds and they'll pay you back, right? That's what your award means. So the costs that you can charge through have to be reasonable for the performance of the award. They have to comply with any award restrictions. So there may be costs that are reasonable, but that are specifically excluded. And they have to be consistent with policies and procedures, this is key, that are applied uniformly across the organization. So you can't have one set of procedures for how you calculate your overhead for federal purposes and another set of procedures for how you calculate it for other purposes. The default is generally accepted accounting principles. That's what we talked about in the last webinar. So basically, this is another way of saying you need a real accounting system. if you don't have a real accounting system, if you don't have anybody who's really capable of saying that you've taken reasonable measures to have a standard system, then really all your expenses under a federal award could be denied. So receiving federal awards is great if you have the capacity, but you need to build the capacity before you get the money, and you need to budget that in, because otherwise managing the money without the capacity can be really, really challenging, and it often totally overwhelms small and new nonprofits. On the compliance side, the award itself will say that the agency can audit or request to see documents at any time. They don't often do that. They usually have to have a reason to do it, but the language is clearly there that they have the right, and so you're saying you have the records in good order. The key thing to highlight for you, this is language that you may have heard or you may hear in conversation. So to be familiar with what's called a single audit or a subpart F audit. The threshold is $750,000, and the key thing is that that $750,000 is of what you actually spent during your fiscal year. So most of you would be on the accrual basis of accounting, and that means that once you have a legal obligation to pay an expense, you show it as an expense on your books. But this $750,000 is calculated on the cash basis of accounting. So even though you, at December 31st, say you had a calendar year, even though you clearly owed $100,000, you had the bills sitting in front of you, they're valid, they all need to be paid, but they're due in January for things you did in December. If you haven't spent that money, it doesn't count towards the $750,000. So we'll talk some more about what this means, but the key thing here is for many organizations that get close to the $750,000, they have some opportunity to plan to avoid the $750,000 if possible, because the audit is costly and time-consuming. So if you're required to do a single audit or a circular F audit, it's going to have to be, you have to identify yourself. They don't come tell you. The whole reason this is called a single audit is that there isn't any federal agency that's in a position to look and see all the different federal awards you might have received from all the different federal agencies. So you are responsible for gathering up all those federal awards, finding out if it's $750,000 or more, and then if it is $750,000, you got to hire the auditor, have them complete the report, and then within 9 months of the end of your fiscal year, you have to file it. It's kind of like filing your taxes. It's a self-reporting obligation. You incur all the costs, and you are the compliance mechanism for the federal government. And then there's some spot audit, kind of like with taxes, some ability for them to look around and audit and see if people are in compliance with this. And of course, if you're required to have a federal audit and you don't have a federal audit, among other things, the spigot of federal money will be shut off, and you won't get any more federal money until you come current with your audits. Important to understand, though, that the cost of the audit is allowable as an indirect cost. It's an even more burdensome process than a regular independent audit. The people who do the audit have to have special extra certification and training, and they do special and extra level of testing. And in addition to the regular financial audit that you might hire just for yourself or for your board or for a nonprofit funder, in addition to testing the financial compliance, they're also going to test compliance with various regulations, various federal regulations, which will include, Congress will get up on some high horse someday and they'll extra want to crack down on something like drug use, and so they'll throw in that you got to have some sort of no drug policy in your handbook, which isn't something that anybody would care about from a financial audit perspective. But if you're getting one of these federal audits, then the auditor has to also look and see that you have these other compliance things in place. All right, so that's all the federal stuff. Some states also require additional reporting Some states require you to submit independent audits as part of your state registration process, and some state government contracts may require an audit just as a state level requirement. So that's on you to figure out within the state where you're incorporated what the additional requirements may be, if any. All right, now we're at the fun and exciting part of this webinar, which is the 1023 and the 990. This is really important. This matters. This applies to all of you. So the 1023 is the application you file for your exemption. You write in it what you say your planned activities are going to be, and they approve it based on what you say you're planning on doing. Then every year you file the 990, which is an annual information return, and in the 990 you say what you did, okay? So you can put those two together. They're looking to see if the two match up, and that's what we're going to talk about today. So when you file the 1023, you write like a whole novel that gets attached, all about what you're planning on doing. And what they're looking for is, first off, that it's organized exclusively for one or more exempt religious, charitable, or educational purposes. So they're looking for anything outside of that exclusively for part. The second thing they're looking for is any scenario where there's individual benefit. And the laws behind this, I'm not going to get into the complexity because it's a lot, but when you touch up against some of these complexities, you might find it extremely burdensome, but you have to understand that there are a lot of bad people out there who set up nonprofits for the purpose of abusing the law and privately benefiting. They're actually incredibly common. So, you know, we all tend to be here, we're in nonprofit boot camp land, and we're all really proud of our nonprofit work and thinking about all these great things that nonprofits do. But there's a lot of people who abuse nonprofits. And so there's a lot of nonprofit law that is set up to try to catch those people and stop them from abusing their nonprofit status. And then the final thing that they'll be looking for is if the organization is really trying to get away with a lot of political activism, but putting it under a nonprofit status. So the two go together because the 990 reports the actual activities and it has to match with what's planned. If there's changes, and that's common, you have to disclose them on the 990. And there's plenty of case law that shows these bad nonprofits going down because basically they wrote something in the 1023, they got approved, and then they did something that was not in the 1023, and they didn't disclose in the 990 that they'd done this other thing. And that's the loophole that the government can go through to shut them down. So what that means for you is that every single year there's a question on the 990 that says, did you do anything new you didn't tell us about before? And you should basically always just jump up and answer the question. It doesn't matter really if you give them too much detail, as long as, of course, it was still within your exempt purpose. That way, if you've disclosed to them any potentially new activity and they don't do anything, then it's basically presumed that they've approved because they haven't. You told them they didn't do anything. But if you don't disclose a new activity and it wasn't ever on your 1023, then they can always come back at you for having failed to disclose that. So this is just a couple screenshots of what the 990 looks like. Most of you should have taken a long, hard look at your 990 by now, but some of you I know are newer organizations and some are under fiscal sponsorship. So just note here, it's open to public inspection, and that you're going to check your different, how you're exempt here. So most are going to be under 501c3. Here's the part that I'm talking about right here, these questions. Did you do anything new? So now this organization, their 990 is fine, but, and I don't know the details of what they were or weren't involved in over the years, but what I'm saying to you is just don't hesitate to check that yes box and tell them about a new activity. So if you were not previously, so if your mission is you train farmers and you were only approved as a farmer training program, and then you start a farmer's market, that really is a new activity. Now, you can make the connection back to your training program, and we're going to talk about this in a lot more detail. But that's a new activity. You didn't put it on your 1023. You'd want to disclose it on your 990. There could be tax implications. We're going to talk about those. The IRS, for sure, if they did read that disclosure, would spot a potential tax issue in the farmer's market. And so you'd want to be ahead of the game and having addressed the potential tax issue. But worst case scenario, if you disclose the new activity, didn't catch the potential tax issue, worst case scenario, they could come back at you for some of the minor tax issues, but they couldn't come back at you for having failed to tell them about a whole new activity. The other point to make here on this 990, this is a public document, is your funders do look here, and people like me look here. Anybody ever calls me about any kind of question about a nonprofit, I'm already looking up their 990. I go straight to their 990 and I judge them. I do. And I can tell all sorts of things about that organization based on little things that I just know about reading a 990. Tells me their level of organization and how seriously they take fundraising. Because the organizations that are a little bit more ahead of the curve are going to take advantage of the 990, and they're not going to give short answers to questions. They're going to say, I am so glad you asked me about my program accomplishments. Let me tell you all about them. I'm going to tell you how many people I served, what programs I had, the benefits, the impacts, basically everything you would put in an application to your funder. You would put in as your program service accomplishments, because your funder may look here before they even read your letter of intent or your application. Some funder, maybe you're so small that you're not filing letters of intent, but maybe some donor hears about you and looks up your 990 and wouldn't otherwise know what your accomplishments are. So it happens, it really does. So you should be treating this as like your permanent record to the world of all the great things you do. And you may have to lean on your tax preparer to take the extra time to type in the longer program descriptions, but it's really worth it. And if you don't believe me, think of your favorite national flagship nonprofit that you know has, big money on the best auditors and tax preparers in the country, and go look up their 990 and see what they've attached. Most of them will actually attach their whole annual report in to the 990 as an attachment, because they want you to see everything about them there from the tax return. So this is an example of an extended description of quite a bit of detail about the nature of the programs. There's some political activity in this program, and so they're making it very clear that although they're involved in influencing public opinion on political issues, they don't have anything going on that intersects with the prohibition specifically against supporting candidates. So the other thing to think about on the 990 and in what you disclose and how you treat it is that a nonprofit is not totally exempt from taxation. So when I oriented you to these rules way up at the beginning about Section 501, within that is some activities of an exempt organization may be taxable. Unrelated business income tax. We'll talk about that. And then anybody who authorizes or receives an improper payment is subject to 125% penalty. You could think of that as a tax, and you report it to the IRS. So I file it under taxes. So let's talk about unrelated business income. This should be something that you think about actively if you are selling farm product. It should be something you think about actively if you have any kind of a gift store, any kind of sponsorship or advertising revenue. And you should, at the very least, have a conversation with your board and have some sort of a written memo to file, internal understanding of how you all have determined whether you have unrelated business income or not, and what activities are critical to your understanding of that, and therefore why you do or do not do certain things, because by doing them or not doing them, it would possibly shift your exempt activity into a taxable activity. So the basic rule is they're looking for a trade or business. A farm, a demonstration farm, can look an awful lot like a trade or business, right? Because most farms are trades or businesses. It's regularly carried on. Well, that's going to be your farm, right? And it is not substantially related to furthering the exempt purpose of the organization. So that's where most people are going to feel that their farming activities don't meet that test, because they are substantially related. But we're going to take a little bit deeper look here. So first thing is, some of you may already be surprised, because many people tend to think that an activity that raises funds for the organization is exempt just because it raises funds for the organization. And that's not true, right? So some activities are exempt from raising funds because they're not a trade or business and they're not regularly carried on. So a fundraising dinner, it's not a trade or business, it's not regularly carried on. Raffles, t-shirts, contests, those kinds of things, that's where they're exempt. But they're not exempt just because they raise money for the business. So a little bit deeper understanding of what we mean by substantially related, and why I think there are some activities that happen on training farms that could be coming up to this unrelated business income line. And I would want you to just, at the very least, have a real conversation with board and some sort of outside advisors and come to your conclusions about how to treat it and why. So the test for substantially related requires a causal relationship to achieving the exempt purpose. So the farm for sure has a causal relationship. You can't teach farming without a farm. The causal relationship must be substantial. Same thing, it's not incidental. There's a very direct relationship there. And it has to contribute importantly to accomplishing the organization's exempt purpose. So again, teaching farming makes an important contribution to teaching farming. So that's all pretty straightforward. But where I get concerned is that some of the ways that the product is sold could be separated from the activity of farming, right? So when the product is sold through a wholesale brokerage, through basically it ends up at a grocery store, that isn't farming. That's a separate activity. And there are cases that indicate that the way that the product is sold and the nature of the sales transaction influences whether or not it's considered unrelated business income. So for example, an item sold at a gift store, in a museum, or at a park directly related to the activities of the museum or the park would generally be considered tax exempt, because that point of sale is importantly related to the visitor's experience of that park. But that same item sold over the internet, the revenue from that item might not be considered tax exempt, because the point of sale was not an educational event, and there was no substantial important relationship between the person buying the book on the internet and the exempt purpose of the organization, which is education. And so in the moment that the person clicked buy on Amazon and got the book, that wasn't an educational moment. When they get the book and read it, it might be educational, but the act of buying it on Amazon wasn't educational. But when they bought it in a gift store surrounded by docents of the park or the museum, that was importantly related, because the gift store itself was educational. There's tons of case law on this. There's even case law where they'll go through the gift store and they'll say these items are educational, these items aren't. So again, my point to you is have some familiarity. Don't assume that everything you're doing is exempt. And don't be afraid. All you have to do, if you determine that you have unrelated business income, all you do is you show it on a different form. And there is really super unlikely that your farm is so profitable that you would end up paying tax on it. Really unlikely, because you're going to allocate the other overhead from your programs. So again, that's back to an accounting question and something you're going to want to work out internally. But my point to you is don't be ignorant of unrelated business income, and don't be afraid of it. Face it head on, come to decision for your organization, and then make sure everybody's aware of what that decision is, why you made it, and how to act on it. Okay, this is even simpler. Private inurement, excess benefit transactions. Don't do it, right? Don't let any part of what the organization does become about benefiting a private individual. This is where this gets tricky in food and farming. A lot of people want to farm, they want to live a certain way, and they believe in food access, and they believe in education, and they don't believe that they're going to be able to succeed as independent farmers. And so they come up with the idea of forming their farm as a nonprofit to get the nonprofit grants and contracts that they can get that they wouldn't be able to get as a private business. That's what gets very tricky, because the same people who form the nonprofit are the same people who benefit from being in that environment. Not saying you can't do it, just saying that's where it all gets very difficult, and there's a lot of rules. And being able to distinguish between the person who's doing that for totally legit reasons in a totally legit way is difficult, given that a whole lot of people try to do it for illegitimate purposes in an illegitimate way and cover it up and make it look legit. So if that looks like you, or if it looks like a farm you know, that's a really good time to make sure that you are in close communication with someone who's actually expert in nonprofit law, to make sure that everything you do is properly documented, so that if they come sniffing and questioning, you're not afraid, because you can show them exactly why and how you're in compliance with the rules. On a more minor case to private inurement, it can be minor things such as it would be a raise that wasn't properly authorized by the board. It could be personal use of a nonprofit vehicle if it wasn't explicitly stated in the compensation agreement that you could use the nonprofit vehicle for some small amount of personal use. So it can be minor things that are technically violations of excess benefit. It can certainly be a loan. Someone takes a payroll advance from the nonprofit. That's a loan from the nonprofit. That is a private benefit for them. Otherwise, they would have had to go to a bank. So unless that's properly authorized by the board as part of their compensation benefits, that could count as an improper excess benefit transaction. So if it happens, and it does, don't panic. You do want to, first of all, immediately repay, and then you'll want to look to the IRS guidance on excess benefit transactions to determine if you need to report it. In technical language, these are called intermediate sanctions, because the IRS didn't want to have to automatically yank everybody's nonprofit status because they had crossed the line here. So the reporting gives you a way to pay it back. You could be subject to up to 125% penalty, but you're not going to automatically lose your exempt status. All right. To wrap up, I want to show you, this is a complaint that was filed with the IRS by an organization that didn't like what the Coalition of Immokalee Farm Workers was doing. So the Coalition of Immokalee Farm Workers was working for better working conditions in Florida in food and farming jobs. That obviously upset some people. So they employed very, very, very basic legal research, and they filed this complaint, which on its surface, when I read this, I went and I looked up their 1023 for myself, and I looked up their 990 for myself, and everything that's in this complaint is true. They start out here at the top of the page, they basically quoted what the coalition said they were, and then they said, and then they looked at what the coalition said in their 990, and they pointed out the logical errors between what they originally said on the 1023 and then what they were reporting on their 990 as their activities. So it was a really simple case of basically using the coalition's own words and own filing against it. And then they said it's not a nonprofit, it's a labor union, and it should be regulated in an entirely different way as a labor union. Then they went on and they said, while we were at it, we just thought we would point out to you that we saw all these errors on the face of the 990, so what's up with that? And then they just listed these things that anybody reading the 990, certainly like myself, anyone who's familiar with 990s and familiar with what they require, could see these errors on the face of the 990. These are things that a paid tax preparer should not have had these errors come through on a 990. So it doesn't mean that the coalition, I don't think it necessarily means the coalition was doing anything wrong or intentionally doing anything wrong, but the point is they left this paper trail that let people who were out to get them a pretty wide open door to come after them. And so I want all of us to think good thoughts about the coalition, but also use them as a good learning opportunity that you don't want to have any daylight between what's on your 1023, what's on your 990, what's on your website. That you got to be telling one story about your organization consistently. It's a great discipline to have anyway, about all your communications being consistent. But certainly if you're doing any kind of work where you could be making people mad, and it doesn't even have to be political, it could just be the neighbors, right, that don't like your farm in their community. For some of you that are doing farming work and farming training or growing food to sell to low-income people, I've talked to plenty of farmers who are not very happy about the all these nonprofit farms they see around them. They have a lot of skepticism and questions. So it could be a neighbor, it could be another farmer who decides to go after you by looking at your 990s, looking at your 1023, they're public documents, and then pointing out discrepancies and making a fuss. So there you go. That's my warning. So the final wrap up of all of this is that if you have federal grants, you want to plan to recuperate your indirect costs. If you have federal money and it's a lot, you want to plan to avoid a single audit. Or if you're going to have one, then you're going to have to start planning well in advance so you can afford that. Your 1023 is a permanent document, so don't ever lose it. Don't throw it out. Make sure everyone in the organization knows it's a permanent document. And anything that wasn't in that 1023 that you're doing better get disclosed at some point on a 990. And the overall communications goal is that you tell one story across all your communications platforms. You may use different words and slightly different messaging, but the basic idea of how your programs are structured, what they're supposed to accomplish, the activities of your organization, how it's funded, that story has to be completely consistent across all of those platforms.